investing is really not complicated. I mean, the basic framework for it is simple. Now then you have to work at it some to find the best pockets of undervaluation maybe or something. But you didn't have to have a high IQ. You didn't have to have lots of investment smarts to buy junk bonds in 2002, or even to do some of the stuff that was available when LTCM got in trouble. You really just had to have sort of the courage of your convictions. You had to have the willingness to do something when everybody else was petrified. But that was true in 1974 when we were buying stocks at very, very, very low multiples of earnings. It wasn't that anybody didn't know that they were cheap. They were just paralyzed for one reason or another. And that the lesson of following logic rather than emotion, is something that's obvious, and some people have great trouble with it and others have less trouble. Charlie, can you give me any more help on that?
Well, I think this is different. When we were young, we had way less competition than you people have now. There weren't very many smart people in the investment management field. There really weren't. And you should have seen the people who were in the bank trust departments. I mean, so now we've got armies of brilliant young people and all these private partnerships and all these proprietary desks and all the big investment banks. And we've got a vast amount of talent in the investment management business. And there's a lot of competition. If there were suddenly a crisis now, there would be 500 firms that would be studying it intensely, each having capital that they could commit on a hair trigger. In our day, we would frequently be all alone.
But in 2002,
we'd be the only buyer.
But in 2002, Charlie, there were tons of people that had investment experience and high IQs, and lots of money was around. Wasn't any question about money. It's just they were terrified of that particular arena.
Well, when you have a huge convulsion, which is like a big fire in this auditorium right now, you get a lot of weird behavior. And if you can,
particularly at the head table,
and if you can be wise when everybody else is going crazy, sure, there will still be opportunities, but that may give you a long, dull stretches if that's your strategy.
3 years ago, you could find a number of securities in Korea, population 50 million, advanced society, strong balance sheets, strong industry positions, at 3 or so times earnings. Now,
but that took a convulsion to create that.
Well,
A big convulsion.
Yeah, but the convulsion happened 3 or 4 years earlier, 5 years earlier, and plenty of smart people in Korea in the investment business, plenty of smart people here scouring. The information was all available. You can go to the internet and get information about Korean companies that's just as good as you get up from the SEC. And there they were, dozens of companies at very, very, very cheap prices. Now, where are all these smart people and with all this money?
It did happen, but if I asked you to name 20 more like it, you would have great difficulty.
I'm not going to name them. Number 8.
My name's Simon Dennison Smith from the UK. My question is this. If you were starting out today with $1 million, with a vision of building a business with 20% average growth in value over 40 years, what type of investments and investment strategy would you look to make in the first 5 years?
Well, it's somewhat interesting that we formed the first partnership 50 years ago, 2 days ago, Thursday, on May 4th, 1956, which was 105,000. That's my sister clapping. She was in the partnership. We would, if Charlie and I were starting all over again and we were in this, Charlie would say we shouldn't be doing this, but if we were to succumb to Satan and engage in same kind of activity, we would, I think, be doing something very similarly. If we were investing in securities, we would look around the world and we would look at a Korea, and Charlie says you can't find 20 of them, but you don't have to find 20 of them. You only have to find one, really. You do not have to have tons of good ideas in this business. You just have a good idea that's worth a ton occasionally. And in securities, we would be doing the same thing, which would probably mean smaller stocks. It would mean smaller stocks because we would find things that could have an impact on a small portfolio that will have no impact on a portfolio the size of Berkshire. If we were trying to buy businesses, we'd have a tough time. We would have no reputation, so people would not be coming to us. We'd be too small a player if you're talking about $1 million. So we would not have much success, I don't think, with small amounts buying businesses. Charlie started out, in real estate development because it took very, very little capital, and you could magnify brain power and energy, or I should say brain power and energy could magnify small amounts of capital in a huge way that was not true in securities. My natural inclination was to look at securities and just kind of do it one foot in front of the other over time. But the basic principles wouldn't be different. I think if I'd been running a partnership a couple of years ago with a small amount of money, I think I'd have probably been 100% in Korea. And, I would be looking around for something that was very mispriced and that I understood. And every now and then that's going to happen. Charlie?
Well, I agree with that. The concept that you're likely to find just one thing where it'll make 20% per annum and you just sit back for the next 40 years, that tends to be dreamland. And in the real world, you have to find something that you can understand that's the best you have available. And once you found the best thing, then you measure everything against that because it's your opportunity cost. That's the way small sums of money should be invested. And the trick, of course, is getting enough expertise that your opportunity cost, meaning your default option, which is still pretty good, is very high. And so the game hasn't changed at all in terms of its basic arithmetic. And that's why modern portfolio theory is so asinine.
It really is, folks.
Yeah. When Warren said he would have been all in one country, that's pretty close to right. He wouldn't have quite done that when he had the partnership, but he would have been way more concentrated than is conventional if you listen to modern portfolio theory. Most people aren't going to find thousands of things that are equally good. They're going to find a few things where one or two of them are way better than anything else they know. And the right way to think about investing is to act thinking about your best opportunity cost.
Number 9.
It's in the freshman course in economics everywhere in the basic textbook. It just hasn't made its way into modern portfolio theory.
We don't get asked to do book reviews.
It's Andreas Rieger from Munich, Germany. Thank you very much for the open discussion that you have with us. Actually, I'd like to ask a question on a book, so I come back to the book review. Jeremy Siegel had some ideas in his second book, and I would like to understand how this would impact your investment strategies, if there are any changes from his ideas, and how you react to these recommendations that he makes. Thank you.
This is which book? Jeremy Spiegel?
Jeremy Siegel, the second book, by the try and the true triumph over the old and the new.
No, it's had no effect on us. Charlie?
No, is that the fellow who is very optimistic about common stock investment over long periods of time?
The University of Pennsylvania, yeah.
Yeah. Well, I think he's demented.
Well, he's a very nice guy, Charlie.
Well, he may well be a very nice guy, but he's comparing apples against elephants and trying to make accurate projections.
Number 10.
I'm Bob Klein from Los Angeles. You've so eloquently stated that you can't see who's swimming naked until the tide goes out. Could you discuss the issue of trying to employ a rational decision-making process in investing or in business generally, as opposed to focusing on outcomes or results of just a few instances or over a short period of time? For example, it may not be a good idea to underwrite some insurance policies if competition has lowered the premiums too far. And likewise, in the stock market, momentum investors may get good results for a while, but buying high and trying to sell higher isn't a good long-term strategy. So I'd just like to hear you guys provide some detail on the importance of using an effective decision-making process, even though it may lead to some bad outcomes and underperformance in the short run.
Yeah, well, Ben Graham said long ago that you're neither right nor wrong because people agree with you or disagree with you. In other words, being contrarian has no special virtue over being a trend follower. You're right because your facts and reasoning are right. So all you do is you try to make sure that the facts you have are correct, and that's usually pretty easy to do in this country. I mean, the information is available on all kinds of things. Internet makes it even easier. And then once you have the facts, you got to think through what they mean. And you don't take a public opinion survey. You don't pay attention to things that are unimportant. I mean, what you're looking for is things that are important and knowable. If something's important but unknowable, forget it. I mean, it may be important, to know whether somebody's going to drop a nuclear weapon tomorrow, but it's unknowable. It may be all kinds of things. But so and there are all kinds of things that are knowable but are unimportant. In focusing on business and investment decisions, you try to you narrow it down to the things that are knowable and important, and then you decide whether you have information of sufficient value that, compared to price and all that will cause you to act. What others are doing means nothing. It's price and all that will cause you to act. What others are doing means nothing. It's what Graham writes in chapter 8 of The Intelligent Investor, that the market is there to serve you and not to instruct you. That's of enormous importance. When people talk about momentum in stocks or charting or any kind of things like that, they're saying that the market is instructing you. The market doesn't instruct us. The market is there to serve us. If it does something silly, we get a chance to do something because it's doing something silly, we do it. But it doesn't tell us anything. It just tells us prices. And if the price is out of line with where the facts and reasoning lead you, then action is called for. And if it doesn't, you forget it and, go play bridge that day and the next day see whether there's something new. And the nice thing about it is there always is something new. I mentioned the LTCM crisis. We on Sunday from people that had portfolios that were in trouble. Now, I will tell you that if you can make a lot of money on Sunday, you may not get a chance very often, but any calls you get on Sunday, you're probably going to make money on. Things are really screwed up if you're getting calls on Sunday. And all you have to do is make sure that you're the callee and not the caller on Sunday. But if you get those calls, you get a call on a Sunday and somebody says that the off the run is trading 30 basis points away from the on the run, all you have to do is decide how you handle that particular piece of information, whether it's correct in the first place, but how you handle that piece of information, whether you can play out your hand. You never get in a position obviously, where the other fellow can call your tune. You have to be able to play out your hand under all circumstances. But if you can play out your hand, and you've got the right facts, and you reason by yourself, and you let the market serve you and not instruct you, you can't miss. Charlie?
Well, I would say some of you probably can miss.
I would say Charlie can't miss, I'll put it that way. He'll agree with that. You have anything further to add on? Okay. At least I've got him off that previous subject. Number 11.